So thanks for staying with us for the industrial panel. So one thing I want to say is now those difficult questions I could not answer. Now you get to ask these guys, right? So let me first introduce our moderator. Our moderator is Dr. Patrick Smith. Patrick is an associate professor and John Crosland Senior Distinguished Scholar in Real Estate. So Patrick just joined us in this fall. So he's new to Charlotte. He's new to UNC Charlotte as well. So Patrick, the floor is yours. And
thank you, Dr. Chu. As Dr. Chu mentioned, I just moved here from San Diego, and I thought moving to Charlotte, I would be able to get a place for about half the price and twice as big. And now I know why I can't do that, right? So this was pretty eye-opening. And I'm new to Charlotte, so I don't have all the answers, but luckily we've assembled an excellent panel today that has a ton of experience. So it's my honor to introduce the panel. To my far left is Mark Boyce. Mark is the founding partner of True Homes, which operates in 5 metropolitan markets throughout the Carolinas and is one of the 15 largest private home builders throughout the United States. So thank you for joining us, Mark. Next in the middle is Brenda Hayden, and shout out to Brenda. Yeah,
I paid them.
We can make this interactive. I like that. Makes it a little easier on me, so I appreciate it. But Brenda is a realtor and broker with Keller Williams, and she's the past president of Canopy MLS. And currently, as if she doesn't have enough on her plate, she's also serving as the chair of the Real Estate and Building Industry Coalition. So thank you for joining us, Brenda.
Thank you for having me.
And last but not least, to my direct left is Scott Wilkerson. He's the Chief Operating Officer of Chief Investment Operator. No, CIO. We'll just go with CIO. That's easier, right? He's the CIO at Ginkgo Residential. Ginkgo Residential is an integrated real estate operating company which focuses on providing, this is a mouthful, but they do it all. They basically do construction, they do acquisition, property and asset management services for apartment communities throughout the Southeast and
North and South Carolina today.
Okay, North and South Carolina. And also Scott has been with Ginkgo for 35 years and is a proud alumnus of the Bell College of Business. So thank you for joining us, Scott. So before I get into the questions, I just want to let you know that we will have 10 or 15 minutes at the end of this session to take questions from the audience. So if I give the panel too many softball questions, you can kind of jump in and ask the tough ones that we heard earlier today. So the first question I'm going to start off directing to you, Mark, and then we'll open it up to the rest of the panel for discussion. And this basically is focusing on 2 of the main points from the presentation that I saw. So the first point is that the Charlotte market is undersupplied and that house prices have gone up rapidly. That's the second point. Those 2 are certainly interrelated. So my question is, what are the supply constraints that are limiting the industry from providing the supply? And then also, how is the rising prices affecting your clients?
Well, thank you. What we just heard was really a remarkable presentation by Dr. Chu. And then the last 2 years, we've in essence accelerated time and gone through a transformation in the market that probably should have taken 10 years to occur. So basically what we've seen is a 5 times accelerator of this transformation in pricing. But the conditions were really set on the supply side in the last decade, where we saw that there was underbuilding here in the Charlotte market over the last decade. Nationally, there's estimates that we underbuilt by as many as 4 million houses. On the demand side, that was set decades ago with the birth of the millennial generation. And the millennial generation is the largest generation in the history of this country. And they're now coming of age for home buying after delaying it for a number of years. And as you may recall, Charlotte over the last decade has been the #1 location in the country for attracting well-educated millennials. So we found really that they showed up in a big way in the last 2 years, and that demographic driver was a key thing for this. As it relates to supply constraints, I think they're key, rooted in our land and lot supply. And there's three things I want to note in that space that are structural. One is the availability of sewer and water infrastructure. That was mentioned in the questions earlier. We've seen an emergence here in the last year or two of some major constraints, particularly in the provision of sanitary sewer. The Wasatch region ran out of sewer capacity. We've also seen in places like Locust and in Union County and 12-Mile Creek watershed, real constraints in the availability of sewer. So that's a structural constraint. The second is in the space of what I call exclusionary zoning, and that is particularly prevalent in the outlying counties and the smaller towns and municipalities that we've seen real impediments for supply delivery because of what I would describe generally as exclusionary zoning or large lot zoning, which hurts affordability. And then finally is just in the regulatory process. And good, there was lots of mention of that earlier. And there's plenty of studies out there that say that in total, both in local, state, and federal regulation, they may add up to 30 to 40% of the cost of a home. And so we've seen an escalation in the amount of regulation. The UDO is, as Dr. Chu said, over 600-page document. And so, yes, it is massive. And so I do believe that within that, we will find some areas of regulation that will continue to constrain supply. As it relates to what our buyers are doing in response, they're seeking alternative mortgages, whether those are 7-year ARMs or rate buy downs. Also, they're spending more of their household income on housing. So all of the figures we saw this afternoon were for a 30% threshold of affordability, but we're seeing we're moving up into the probably the mid to high 30s as a percent of income that is being spent on housing here in the Carolinas, or particularly Charlotte. Now that compares to high cost markets like what you've come from in California, that may be anywhere from 45 to 50% of household income. So comparatively, we're still affordable compared to that, but we're well off where we were just a few years ago.
Thank you. Thank you for that response. Would Scott or Brenda, would you like to?
I'm not involved in single family housing, but I think a lot of the issues are the same. The question about whether government officials, regulators, whoever you want to talk about, consider the cost when they pass things like the UDO and other rules and regulations that John Huson, as John heads Caricon Construction, which has probably built more apartments in the Charlotte area than anybody over the last 30 years as a contractor, not a developer. John's on my housing affordability committee and for the ANC and GCAA, the apartment associations, and we deal with those issues. But what it reminds me of is when John Crosland Jr. was still alive, he gathered a small group of us. He went around, he did this with various groups, and he talked about the rules that had been written for, John, you know all the technical terms, the streetscapes, the neighborhood development, how close roads had to be, how wide sidewalks had to be, how many trees had to be planted. And he pointed out that not only did it add substantial cost, not that people don't, including myself, don't like wide sidewalks or trees or green space. I love it. But he talked about how it added so much to the cost, and also pointed out that some of what are often viewed as neighborhoods that people really like in Charlotte, some of the higher income neighborhoods, some of the middle income neighborhoods that people really like, you could not develop those under those rules today, both physically or financially. So it's a tough situation. And I don't know any special answers to it. But I do know the Dr. Chu's comment to one of the questions. You know, I live in a single family home. I hope everybody has that opportunity, but large lot, single family homes use up an awful lot of land. And if you want to get green space, you can't cut it all up into individual lots. You've got to go vertical with density and then accumulate that green space. And then, as Dr. Chu said, make it accessible to everybody.
And I noticed, Mark and Scott, in both of your answers, there was the discussion of affordability, and affordability was one of the main takeaways from Dr. Chu's presentation as well.
Yeah.
Brenda, I'll direct this question to you. What is being done and what needs to be done to increase the supply of affordable housing here in Charlotte? And are there incentives in place to incentivize developers to develop more affordable housing?
Great question. What is being done and what needs to be done? My opinion of what needs to be done is a will for the community, make it so. And when we look at the UDO will serve a particular purpose. It will increase density, but there still has to be a will for the community to do so. The NIMBYism, if we want to really address affordability, we have to be willing to say yes in my backyard, which speaks to accessory dwelling units. That will help some of the issue, not all of the issue, when we look at the report. With household size, accessory dwelling units, that's not going to meet the need for a family of 4. That's just the reality. It might meet if it's just you and a partner, but when you look at the household size, ADUs are not necessarily the answer. So we have to look to what the policies are, public policy, what costs are associated with performing those, and create an opportunity for builders and developers to do their work and not have those costs, the additional costs passed through to the consumer. As far as what's going on in our current marketplace, in the last 2 to 3 years, quite honestly, it's been about 5 years where we've had institutional investors come in to our market and quite literally absorb a lot of the housing when we look in the lower quadrant, the lower percentile. Anyone that works in our space as realtors, we know what the ideal home is for most institutional investors. And it's most of the lower 25% homes. Recently, a report came out said in North Carolina, institutional investors purchased 15% of the homes in our state. When we look at Charlotte and other large cities like Raleigh, the numbers get closer to 30. Those are homes that come off the market for everyday people. Not sure what that answer is, because currently there's no law, there's no rules against it. But that's an issue. And when we look at that fact and project forward, if I own 30% of anything, I control the market. So on the sales side and even on the rental side, because if they're purchasing these homes and they're holding it, then I get to dictate, or they get to dictate, what the rent it will be. So it's definitely a compound solution, but there has to be the will.
Scott, or would you like to jump in and piggyback off that?
I'm sorry, it was a mic drop moment. I promise to behave today, but
Well, in our business, we build new homes,
Yeah.
and really for the last 2 years, we've not sold to investors, and we're exploring ways to restrict the amount of rentals in our neighborhoods as it relates to resales, because we don't today control those resales. But that, limits homeowners' options. And so, it's a difficult question and difficult challenge. But again, we don't sell to investors. And so at the onset of our neighborhoods, they have a home ownership orientation in our neighborhoods. There's a lot of developers that are building single family neighborhoods that are exclusively for rent. And that is a new segment in our industry. And it's a very viable, and they're very, very successful. So the market is validating that as a concept. And so it's been successful in the Western cities, and it's also been successful here in the Carolinas. So in the Carolinas, about 35% of all housing is rental housing, and single family rentals have been a critical part of that structure really throughout history. It's been mom and pops in the past. Now it's more institutional. And so, yes, institutions may have the ability to wield more market power, potentially, as Brenda said, but on the other hand, they also have capital and efficiency. So they have capital to make improvements to that housing stock, which is available capital that a mom and pop operation might not have. So we have potentially a better housing quality as a result of that. And they also have efficiencies in their management systems that they can pass on potentially in the form of more affordable rental rates.
Well, there are more than 200,000 apartments in the area alone that are members of the Greater Charlotte Apartment Association. So I think the institutional owners, the number I heard, own about 11,000 single family homes. So that wouldn't control our market at all. On a personal note, I have a home next door to one of the institutional owners, but mom and pops own two houses across the street. And I have to tell you, they've been excellent neighbors. All of them have been excellent neighbors. It actually surprises me. And they have, all three have spent money on the property. And I've met both mom and pop.
So, and I will say this, there are builders out there like True Homes that do make an effort. I know I've seen some of your product where they will build a detached garage with an ADU above, and that's been going on for several years now. My concern as a practitioner of real estate, again, is not necessarily only what's happening today, but what does that look like in 5 years? We know even though our population growth has ticked down, it's still growing. Charlotte is still a very desirable place to be. The census, we skipped a year for COVID, granted. But what does that look like going forward as our international borders reopen and Charlotte Douglas continues to grow and people come here from other places? They're not going to come without somewhere to live, right? So we really do have to address putting units on the street. What does that look like? Going vertical. I love trees. I'm a tree hugger. But I love for people to have somewhere to live as well. The homelessness situation that we see in major cities like San Francisco, we don't want that here in Charlotte, right? We shouldn't have it or want it anywhere, definitely not here in Charlotte. So I feel what's happening 5 years from now will be a telltale to what we do today. How open are we to different zoning restrictions and opening that up so that we get greater density?
Yeah, and I believe the figure that you mentioned, Scott, Urban Institute here at UNC Charlotte actually put out a report saying that Wall Street-backed landlords or institutional investors purchased approximately 11,000 houses here in Charlotte. So if you haven't read the report, I think that's where that number is coming from. And the Urban Institute has some really great resources. So I recommend kind of checking that out. That's just the plug for UNC Charlotte once again.
Yes.
So let's switch topics a little bit here and move from owner-occupied, I guess you'd say, market to the rental market. We did spend a little bit of time on that in the presentation. So one of the things that stood out to me, and I got a sneak peek at some of the numbers ahead of time. So I didn't see this number specifically in the report, but in the sneak peek I saw it was that the average effective rent went up about $200 per unit here in Charlotte, which was about a 17% increase in 1 year. So I'll direct this question to you, Scott. What led to the large increases in rent over the past couple of years? What's happening in the market today? And then how do you see rents performing over the next few years?
Thanks, Patrick. First of all, I'd like to tell you, I appreciate your efforts to do bios without any notes. And I understood that you got some notes that weren't quite right for me, and I apologize for correcting you, but I got people in the audience who give me a hard time if I didn't. So, I'm old and I don't remember everything. I took a lot of notes from Dr. Chu, so I've got my notes in front of me and I will look at them some. But first of all, it's important to note in the apartment side of the business that a lot of people have misconceptions about the financial side of it. A study that was updated in 2020 using 2019 data found that the typical apartment community in the United States only about 10 cents out of every dollar of rent came back to the both owner of the property to pay their investors, to pay the people who made it possible to own and operate that apartment community. And that's a pretty low number. So it's not like the margins are huge. And that's available to you. If anybody wants it, I'll be glad to share the link to it. But so you start with about 10 cents out of every dollar. Then you got to keep in mind that all costs, it's not a perfect trail from day to day, but over time, all costs wind up in the rent. Everything is paid for by the renter. There's not some magic pool of money, with the exception of government subsidies, housing choice vouchers, which are very limited, tax credit funds, which are also extremely limited. So while there is some subsidy and there are some angel investors, whatever you want to call them, who will take lower returns, as a general rule for those 200,000 market rate apartments that I'm talking about, you have all the costs are paid for by the renter, and there's no other way for it to work because they are truly market rate. In 2020 to 2021, as everybody has seen, costs have soared upward. In everywhere you look, those costs are up. Water and sewer costs, they went up in 2020. I think they've gone up twice this year for two different reasons. The insurance prices, I don't know if you got your new insurance bill for your house, but you're not going to be happy. Our insurance costs have soared upward. In fact, we just priced insurance on a community and all of our regular insurers said, they're just not going to insure it. They turned us down. We've had to go out to somebody else, and it's going to come in at about 80% higher than we had projected. And that was based on recent history at other properties. Everywhere you look, supplies, paint, payroll, taxes move up. We have a revaluation here in 2023 that was commented on earlier. I don't know what's going to happen, but it's your taxes are driven by the combination of your percentage of the total tax base. So if you go up 20%, but everybody goes up 20%, and the city reduces the millage rate and the county by the appropriate neutral number, your taxes don't change at all. But if yours go up 40% and the average goes up 20%, you're going to have a substantial increase. So we'll know that sometime next year, but taxes have gone up or expected to go up. I mean, everywhere you look. A couple of things, though, that have happened in the last couple of years. The biggest one was the eviction moratorium. I mean, in March of 2020, we entered into a period with an eviction moratorium put in place. There were virtually no limits on it. It applied to virtually everybody. And it didn't go away until about 18 months later. So for 18 months later, and I know some people who owned one or two single family homes and their residents didn't pay them and they couldn't do anything about it. In our apartment world, luckily, most of our residents did pay their rent. We made payment plans, we flattened rental rates, we did all kinds of things to help them out. We tried to help people go and get rental assistance, which lagged terribly behind the start of the moratorium. But even with that, we had an awful lot of people who, we literally had people tell us, I don't have to pay you, I'm not going to pay you, and until the courts reopen and you can get us through the process and have the sheriff lock us out, we're staying and we ain't paying. And that went on and on. So bad debt, which is one of those costs, soared. It's soared upward. Okay. The other thing that started is fraud has exploded. The number of fake applications, some of them are outright identity theft. Oftentimes they're fake payroll stubs and other things have also gone up dramatically. And so all of those are costs. So when you look at what happened to rent, in the bigger picture, those costs, like healthcare, like retail, like every other business, the people who pay also pay for the people who don't pay. Costs have shifted every day in healthcare. If you go into the grocery store, and I used to work for Harris Teeter many years ago, and they talked about this, the percentage of goods that disappear are priced into the percentage of goods that are paid for. And I got lots of examples on that that didn't work out too well. But all those costs get priced in. And the big kahuna today is interest rates. It's affecting your business dramatically. I mean, when you go, Dr. Chu showed 3% to 7.5%. I had the numbers for 3 to 7. I'm a little behind the times. But it's about a 60% increase in the monthly principal and interest payment that you have to pay for the same number. And if you want to talk about a correction in the housing market, I think I'm right about this. I mean, houses would about have to fall in half to get back to the payment that someone would have had at that 3% rate. You can check my math on that, but it's dramatic. And as Dr. Chu said, he is not expecting that. He didn't say the prices were wrong. He said the prices aren't going to go up as fast. And I think that's true. Well, the same is true for the apartment world. We had a severe supply-demand imbalance that hit particularly hard in the third quarter of 2021, but it started back in the third quarter of 2020. You had the numbers on the screen. This explosion of household formation coincided with the time period of lagging, not zero, but lagging availability, plus that household growth price point did not always match up with that availability. So in the fall of 2021, I had somebody come to me and say, look, we'd like to bring 18,000 refugees from Afghanistan to the United States. Can you help us find them an apartment that we can put them in? I said, we have nothing. As an industry, we are full. Everything is rented almost like 3-day sale of houses. Everything was being rented immediately when it was available. And between the cost increases, the bad debt, the number of people living in apartments that weren't paying for them, because we couldn't do anything about it, which is a reduction in supply. All those things combined to push rents up naturally. And I'll have to say, apartment owners sitting there looking at the losses, not knowing if they'll ever recover because these rental assistance programs took so long to kick in. We were trying desperately to help our residents collect that money because we wanted them to. It was good for them. It was good for us. Prices went up. They went up dramatically. Now, 16.6, you didn't present this, but I think that's in the report, is you said you rounded it to 17%. That's a pretty good number for the average, but the average is the average. The average is not the same apartment because we did add new apartments, which are very expensive. We added apartments, a couple of big properties in South Park, a ton along the south end, along the Blue Rail. Go, if you haven't done it, drive through NoDoc, drive up the Blue Rail to the UNCC main campus, and you will be shocked at what has gone on in a very short period of time up there. So we added a lot of supply of very expensive apartments, and they moved the average up pretty hard. I went and looked at one of the local research companies, Carolina's Real Data, which I subscribe to in addition to CoStar and some other data, and they have a same units comparison number. So it's not exactly apples to apples, but it's close. And they show a 9.1% growth in asking rental rate roughly during that same period. So whether it's right or it's wrong doesn't matter as much as just compare it to history. In 2020, that rate was about 2%. For the 4 years ending in 2020, it was about 2.6%. In that following year, 2021, it was 9.1%. So it's still a dramatic increase in rent. And it was driven by a lot of those factors that I talked about. Now, today, in the third quarter of 2022, rents are coming down, asking rents. Now, if you rented an apartment and have a low rate, I'm not telling you you're not going to get a rent increase from your rental housing provider because you are way below that quote market rate. But the market rate that new people are being asked to pay has come down, and I think it's going to continue to come down for a while. CoStar reported in their latest data that the trailing 12 months were, I think, 6.1% rent increase on average. So that 16.6 in 2021, I think compares, I think I got the right number, to 6.1 now, and that's going to continue to moderate down. We will not find that overall rents decline. The asking rent is coming down some, but that growth in households that you talked about, even as we return to norm, those supply-demand dynamics will meet again, and we'll just grow at a more traditional rate, which normally is just a little above the rate of inflation of all the things, not the general inflation rate, but the rate of inflation on the things that go into housing, which are a little different from the overall. We don't need to buy milk to build to make apartments and to operate apartments. So that's not in that number.
Just for the sake of time, I just want to jump to the next question because I think you answered it all. And I don't think that's that was the second mic drop moment of the presentation. I'll direct the next question to you, Mark. One of the unique things about Charlotte is that it's the headquarters or the regional home of a lot of large banks. So how do you see the banks contributing to the solution to some of the issues that we've discussed?
Well, I think the bank leaders in Charlotte, and particularly those directors of ESG, are increasingly aware that wealth disparity in the United States is primarily driven by housing disparity or inequality, not income inequality. So let me repeat that. Wealth inequality is driven by housing inequality, not income inequality. And just as some statistics, the Urban Institute report says that the disparity between Black home ownership and white household home ownership is 30 percentage point difference. The difference between Hispanic home ownership and white home ownership is a 20 percentage point difference. Put that in historic perspective, in 1960, that was only 27% difference. So in 1960, when housing discrimination was fully legal across the United States, we had less disparity in home ownership between Black and white households. And so that is an issue for the banks, I think, for them to be leaning into. And so here recently, Bank of America has announced leaning into this space on a pilot program in 5 metro markets, and Charlotte is one of them, with what they call the Community Affordable Loan Solution. And so that's mortgages that are targeted to decrease that disparity in home ownership. We're working in collaboration as a private builder with Bank of America and Dream Key Partners, housing not-for-profit, to provide homeownership opportunities into these locations where they can take advantage of that loan. The House Charlotte money, which is part of the Housing Trust Fund, where the city comes in, and then Dream Key Partners through homeownership counseling. So we're leaning into solutions across the for-profit sector, which would include us as a builder, and the banks, the not-for-profit sector, groups such as Dream Key Partners, Community Link, Dempsey is here today. Also the faith community, we're inviting them to the table. Our churches and places of worship have, in many cases, have excess land. And then finally, the philanthropic community, because we believe that through these impact networks, we can efficiently apply our skills in a impact network to bring to bear solutions that should attract philanthropic funds, because we think we can do it most efficiently. So I think the banks need to be continuing to lean into the table in this space. Brenda had mentioned that ADUs, she believes, could be an important part of the solution by inviting people to say yes in my backyard and build a accessory dwelling unit or a backyard home, which should be able to rent for a very affordable price. And so we have a pilot program that we're asking lenders for a $5 million loan where we can deliver 50 ADUs through what's being called a True ADU Trust. That's in collaboration between True Homes and Dream Key Partners. And we think that that pilot program can prove the financial model as well as a building model for ADUs here in Charlotte. Now, Los Angeles, in comparison, is one of those markets, if it was on our chart, would be 8 times median multiple. They also have 80,000 homeless people. Well, right now, they are desperately seeking solutions. And so for the last few years, they've been leaning hard into the ADU space in much more of a reactive response. What we have the ability of here in Charlotte is to have a proactive response, to read the signs and say, well, we may not be there in 10 years, but we may be there in 20 or 30 years. So if it's going to be a work of a generation, then we need to be after it now. So we may only have 3,000 homeless in Charlotte today, but we can look to those other examples, communities in California, where housing unaffordability is absolutely impacting the community dynamics and community health. And rather than being reactive, the building community, along with the banks and the bank leadership leaning into the space here in Charlotte, bringing these solutions to bear now, and then giving us time to bring them to scale in future years. So that would be my challenge and encouragement. And again, we have the prosperity here in Charlotte, and we have the bank leadership that I think can have the foresight and would invite them in with the building community to bring these solutions to bear.
Thank you. I'll ask Brenda and Scott if they want to comment. Otherwise, I have a couple more questions, but we're running out of time, so we'll actually open it up to the audience after Brenda and Scott comment if they'd like.
I have a comment, and I'll preface my comment by saying this is Brenda Hayden speculation, okay? We do have House Charlotte managed through the Dream Key Partners. Those are housing trust fund dollars that come down from federal through the state, if you don't know the path. One of my thoughts when it comes to the banks, when it is for a higher level of transparency, if you will. Being an African-American female and having had student loans, I know the journey. I don't have them anymore, and I've made sure my children don't have them either. A lot of would-be homeowners are denied because of debt-to-income ratios. Your DTI, what you owe is far too high compared to what you bring in. These are working professionals. I would bet money, most of them have really fat student loan debt. We use down payment assistance secondary to the first loan approval. The challenge is if they can't get that first loan approval through the banks because your DTI, why are we not utilizing those DPA funds to cure the ill on the front end so that they can qualify for the home and thus might not need the down payment assistance on the back end? That's just something I've been toying around in my head for a minute. So when the question is, what can the banks do? I know we have great banking partnerships. Most of them are my friends as of today. Don't know about tomorrow. But and I get it, because you have Community Reinvestment Act programs. And no bank wants to be the one that says, yes, we declined X number of would-be homeowners for DTI. Nobody's going to come out and put their paper on the table, their cards on the table. But until we can do that, we really can't address the issue. If folks, especially minority, women, people of color, the working class people, if they can't get home loans on the front side, DPA is useless on the backside. So let's kind of like flip the script, if we will. But in order to do that, we have to know the ill we're addressing. So that would be my comment to what can the banks do.
I agree, Brenda. Finding a solution to that, the student loan problem would really help a lot of people. You're talking about young professionals, so they can make their payments. It's not like they just are looking for, a payment that they can't make. They can make their payment. They can't get qualified. I mean, when I bought my first home, I went to UNC Charlotte, as mentioned earlier. And in 1981, I bought my first home when interest rates were 17.5%. And they didn't count my student loans against me. I can't tell you why. I can just, because I would not have qualified. They didn't count them against me, and it took me 13 years to pay them off. But they didn't do it. And today that's not the case, as my understanding. They all get counted against people. So finding a solution to that student loan problem would be a really big deal and would help a lot of people.
And I would add, Scott, thank you for that. They are doing this, I believe, in Chicago.
Are they?
in that area. So it's not, it's not that it can't be done. It's just how do we make it happen here in North Carolina?
So we have about 8 minutes left for some questions from the audience.
Good afternoon. Thank you. Is this on? Okay. For the panel, I think this question is probably best suited for Mark, and maybe Brenda might be able to chime in. Can you speak to what True Homes might be doing, exploring, or implementing in terms of making advances in affordability from the construction side? There is no shortage here of criticism for the UDO. Complete transparency here. I'm chair of the Planning Commission, so UDO is our wheelhouse. We're the vetting authority, I believe. So I agree to a certain extent that yes, regulation is not the favorite thing for our development and building industry. However, what might the building and construction industry or home building industry be doing to make advances in affordability from their side? I hear that the city of Austin has currently now an entire single home community under construction of 3D homes to take those strikes on affordability. What can True Homes or other home builders do? What other construction advances in technology can be explored so that the affordability is addressed from both sides, from the regulation side, but also from the construction, building, home building side?
Good question. So yes, we, this last year, put one of our lead executives with a singular focus on innovations that might be available in the construction space for us. So we've prototyped ADUs. So we're in that process right now. One of those ADU prototypes is a net zero house. And so we think that that is great for long-term affordability and both the renter on that backyard home. So that is a proven model for us. That's about $15,000 additional cost. We're also working on a innovation out of Canada on our electrical system, which is the Levin system. And we're meeting with the head of the Department of Insurance actually this week to try to get approval statewide on that. We prototyped that technology in Davie County earlier this year, and that allows labor efficiency. It also is a more high-tech product, if you will, from an electrical standpoint. But the key cost savings is on the labor and the wire in the home. So those would be a couple of our initiatives that have borne fruit. We've also been in a national benchmarking, visiting builders of modular and offsite construction throughout the country, including panelization, and we're consistently measuring that against our onsite stick build, if you will, processes. And everything, again, for the last year, all of those benchmarks have come back and proven that with our cost of labor here in Charlotte, which is comparatively low compared to some other high-cost locations where modular or offsite production makes more sense, that our on-site build is consistently a cost advantage as compared to off-site build. So those are the spaces that we're working in. We're always working on product and land planning innovations for higher density. And so we have a variety of new townhome products that we've also designed that are higher density. So going to 3 stories instead of 2 stories with parking underneath. So some of those products we're taking through zoning and planning commissions right now. So that many of those products you may not see because of this lag effect in our regulatory process and land development process. Many of those products you may not see for 2 to 3 years. But they're definitely on our boards and they're on agendas with planning commissions in each one of the 5 markets that we operate in.
Thank you for that response. And if there are any other panelists that can address, but I was going to ask as a secondary or a follow-up, what resources has True applied to keep the attention there? how are resources applied to kind of continue or sustain the attention to affordability from the construction side, including being innovative with labor and other practices. But I think you hit that with that last remark. Thank
Well,
you.
the other thing that we have done is we've also in the last year started our own framing company and also our own HVAC company and maybe starting a plumbing company. And the focus there is to build a labor force. So we are working with high schools and community colleges in their certificate programs and providing internships. Each of the last 2 summers, we had 50 high school students working and paid internships with over a dozen of our trade partners. And so they're learning the skills and seeing this pathway. And then we've also, which we call our Builders Bridge Initiative. And then we're also connecting with community colleges, which more and more have building trades programs that they're establishing. So we're creating pathways for a vocational opportunity and living wage jobs and instilling in that work efficiencies that will then translate to cost savings for us in the long-term horizon as well. So we think, again, we can create vocational opportunity for great living wage jobs, but also gain productivity and efficiencies in labor productivity that will lower our cost to deliver our products as well.
When you think about cost though, don't just think about new construction, think about existing properties. And I assume this applies to existing single family. That's not my business. Existing, particularly 30 to 60-year-old multifamily properties are. And I mean, we give you a long list of times where we touch something and the costs explode out of control because of code or inspection related issues. Now, I'm not advocating things not be safe at all, but you know, when we are fixing something from a fire and we have 4 different mechanical, plumbing and electrical inspectors with 4 different set of requirements that don't match up with the prior inspector, it's time and money every single time. Every time we do what they want, then we get a new inspector, they have a new set of requirements, we have to do it again and again. And of course, my favorite example was a property where we wanted to put a microwave in. They said we had to put a 110 volt circuit in for the microwave. No problem. Problem is that wire had to connect to the electrical panel. That electrical panel was deemed unsafe. I couldn't tell you whether it was or it wasn't. Fine. We'll put in a new electrical panel. Well, wait a minute. The new electrical panel now has to meet the new code. Well, the new code not only says you have to upgrade a whole bunch of things, you can't have it here. Now you wait till you get the cost to move the wiring to another location. We got lucky. We flipped it to the other side of the wall. We put it outside. It met the code. We had to buy a higher price box, no big deal. But all of those things ripple through. We worked it out, but the cost went up. And that happens again and again and again. Again, nobody's advocating unsafe conditions, but things that are grandfathered if you leave them alone, safe, grandfathered. But if you touch them, you've got to bring them up to new code. It's a problem. We need a better renovation focus. And I know that's more of a state issue and a code issue than it is a city and a county issue, but the result is the same. Yeah. And burn down, which we've had our share of, is different than just fixing 1 unit in an existing or 2 units in an existing building, but you still get hit with a lot of those issues.
So unfortunately, we've run out of time. The good news though, so that's the bad news, but the good news is we have a reception where we'll be able to continue the conversation right after this. However, before we go, we have to thank our panel for coming. I want to thank Mark, Brenda, and Scott for all the insights they provided. I definitely learned a lot more about Charlotte. And then I just have 4 housekeeping items that I've been asked to announce before we go to the reception. The first is that we want to thank our research partners and our sponsors for helping us put on the event. There's a lot of work that goes on at UNC Charlotte, but it wouldn't be possible without our research partners. So thank you very much for that. Second, I want to thank our audience for joining us, not only in person, but also online. And also let you know that we have our QR code if you want to download the State of Housing report. So you can just, and I think the QR codes are spread out outside the room as well. Or you could probably go to the Childress Klein website as well to download it as download the report. But all the information that was presented and even more will be in the report as well. And third, I've been asked to make you aware of our next event. So please join the Belk College on December 7th for the virtual North Carolina Economic Forecast. It's something I've been told you won't want to miss. It's gonna be my first one. And I've told that it's a great event. So that's on December 7th. And then lastly, please help us plan for future events by completing a short survey. By doing so, not only will you be helping us, but you'll also be entered for a chance to win some Belk College merch and swag. So you gotta get the green and wear the green as much as possible. So thank you again for joining us. And we look forward to seeing you at future events and also at the reception. So thank you very much.